Hello, and welcome to the latest edition of What's Up Monday. This is Dominic Chiricheller of the Energy Management Institute. I'm pleased to be with you, and I'm going to take the opportunity to walk you through how I see the market and what we see evolving here over the next week or two, and hopefully it'll be of use to you in your trading and hedging or analytical areas that you may be involved in. You can see down below on this particular slide. You can click on that. You can actually subscribe and get an additional trial for our What's Up Monday. And if you do have questions along the way, certainly feel free to contact me directly at dchiricheller@emi.org. I'd love to hear from you and certainly would be very enthused in answering any questions that you may have. So let's get started and let's look at what we see to be some potential market moving events coming up. First, let's just go back a little bit here. The last 3 or 4 weeks have been interesting to say the least. I guess it would be somewhat of an understatement. We had about a 10 or 11% correction in the equities market. We had the whole trading community starting to quickly be concerned about inflation, higher interest rates, and changing in the economic conditions here in the United States. Growth is still on the table. U.S. economy is growing faster than it has been in a long time. Unemployment is at the lowest level in many years. And as such, the Fed is probably going to start raising interest rates. And the market got a little bit spooked with that concept here. And I think it was more of, boy, there was just about everybody in the world was long equities. And we had a bit of a strong round of profit taking selling. It did decrease more than 10%. So that's referred to as a correction. And then since then, we've kind of recovered. The last 2 weeks, we've seen a recovery in equities. We've seen the dollar still higher versus most currency pairs, but certainly the quick uptick, not so much. And as of the end of last week, the bond market started rising, meaning interest rates started easing here a little bit. So whether this is going to continue, whether the market is going to be overly concerned about potential inflation going down the road, that remains to be seen. Even with the Fed likely to raise interest rates here over the course of the next 6 months to a year, they're starting at a very low base. And by the end of 2018, even with 3 or 4 interest rate increases, it's likely to still see interest rates that are well below the long-term historical average. So, yes, concern is in the air. Yes, volatility has increased significantly. And yes, the changes in the equity markets, changes in the direction of the dollar is certainly contributed to the volatility and the impact on the oil complex as well as the broader commodity complex. So yes, we're maybe in a transition period here, but yes, again, that means there's going to be opportunity. So we need to watch it. So we'll talk a little bit about the price direction and snapshot and some of the key spreads that are going to be impacting the market and how they're going to be impacted as we move down the road. I'm going to talk a little bit about the externals, interest rates, the direction of the dollar, and certainly the direction of equity markets and the implication it has on which way oil is going to be going. We'll talk a little bit about the changing short-term fundamentals. I'll give you a little bit of a quick forecast as to where I see inventories coming out this week. Inventories will be on their regular normal schedule. Last week was a shortened trading week because of the holiday last Monday. So inventories didn't come out till Thursday. This week we're back to the normal cycle. API data Tuesday night, EIA inventories at 10:30 a.m. on Wednesday morning. We'll see. Talk a little bit about OPEC, a little bit about the weather and some of the evolving geopolitics that are potentially could impact oil going in the near term. So let's start with a little bit of a snapshot. This is as of Friday. We saw oil did uh, increase nicely on Friday. The Brent WTI spread widened. Products also increased on Friday. And we had a great recovery in equities for a week where equities increased almost 2%. The global EMI index increased about 2% last week. The Treasury market was a little bit higher, meaning interest rates eased a little bit, and the dollar was just marginally higher. So kind of a neutral to maybe a slight negative on oil prices. The broader snapshot, we could see, oil is still running above its 12-month average. It's certainly a 12-month forward curve, I should say, and certainly well above the average for 2017. But we're off of the highs that we hit earlier in the year. The spreads, the crack spreads are towards the bottom end of the cycle, marginally above where they were in averaging in 2017. And natural gas is still well below where it was last year on average, as we really had not a very cold winter. So it certainly contributed to what's happened there. So let's look at WTI and Brent. We peaked here around the third week or so of April. We see that in both the April WTI, the April Brent contract. And then we had this sell-off, as we talked about, in equities. We had the dollar rising, and we had a subsequent sell-off here in the oil market. Over the last week and a half or so, we're starting to see a bit of a recovery. We're not near the highs yet, or we're not at the highs yet, but we're above that 50% retracement area, and all signs right now from a technical perspective, we could see the MACD is giving us a buy signal. We're seeing both the directional movement index and the RSI as being mostly neutral, so plenty of room. The market is not crowded, and the market is not overbought anymore. So from a technical perspective, it's looking like we can move higher here in the short to medium term. And if we get some support, ongoing support from the short-term fundamentals, certainly we would expect to see that continue. On the spread side, I got two different charts here I wanted to show. The chart here on the left is the April Brent versus the WTI cushion spread, the delivery location, the NYMEX WTI benchmark area. And on the right, I have the April Brent versus the WTI Houston pricing. It's not nearly as liquid, and I don't have not enough liquidity to show a nice candlestick charts like we have here on the left. But so I chose a line chart here. I mean, directionally, they're both moving. They both have been moving in a downward trend. We peaked back here towards the end of last year with April Brent above the WTI by a little over $6 a barrel, and similarly the April Brent over the WTI Houston higher by about $2.30 a barrel. We've been trending lower, but over the last week we saw a little bit of a recovery in the spread. Part of it is an ongoing commitment by OPEC on the international side. And offset, though, we've seen U.S. crudes continuing to go down. Cushing inventory is down to 30 million barrels, significantly below where it was, actually below the 5-year minimum, let alone the 5-year average. So we're probably going to see this spread maybe recover a little bit, but we're certainly, both of these spreads are certainly at levels that are still supportive of the exporting of U.S. crude oils to the international market. Actually, last week in the weekly EIA snapshot, they reported crude oil exports of just a slight tad above 2 million barrels a day. That's tremendous, and that's a large increase. Again, technically, we see the spreads that the MACD spread is suggesting higher values, and we see the ADX, Directional Movement Index, and RSI as being somewhat neutral at this stage of the game. So we can expect to see the spread widen a little bit. As the spread widens, certainly it continues to support the economics of exporting crude oils from the United States, which is contributing to the reduction in U.S. crude oil inventories, even though U.S. crude oil production is at a record high level at this stage of the game. If we look at that Brent WTI spread, we could see, we're above that 5-year minimum. It's below the 5-year average, and certainly, longer term, depending on how U.S. crude oil inventories evolve. I mean, we could eventually see this spread, staying in a trading range, then eventually moving down to more historical levels. Remember, historically, WTI traded at a premium to Brent. Then that kind of changed once we became landlocked in Cushing, and Brent surged to over $30 a barrel above WTI. Then with the transition to all the new pipelines and the exports coming out of Cushing, we've kind of come down to closer to normal levels. But we're still trading with Brent at a premium to WTI. At some point in time, that should get down to a closer to lower level at this stage again. But we'll have to see how the inventories evolve. Right now, as I just mentioned, the technicals are suggesting a slightly higher uptick to the spread, and certainly the spread is very suggestive of exports being economical. Let's quickly look at the products market, both the low sulfur diesel on the left and the RBOB gasoline contract on the right. Both of these products are in a uptrend. They've both now hovering around the upper resistance area of the linear regression trading channel. We're heading into an environment, refinery runs continuing to decrease. We're just beginning the spring maintenance season. Refinery runs are already down below the 90% level. So what we could expect to see is obviously less products produced, a little bit of firmness coming for both the gasoline and diesel fuel. And again, we could see that. Technically, we're supportive with a MACD moving up, neutral on the RSI and the ADX, and as I've said, from an uptrend point of view over the last 2 weeks. So positives and potentially higher prices here heading in the short to medium term. If we look at the crack spreads, after falling considerably since peaking towards the end of last year, we see both the diesel crack and the gasoline crack have now kind of turned the corner. The diesel crack a little bit more pronounced. The upward trend line is a little bit steeper. The RBOB crack spread's a little bit less pronounced. Inventories of diesel are a little bit more constructive than they are of gasoline right now. But technically, again, we see higher prices. I'm starting to like the crack spreads. I'm starting to looking for an opportunity to go long either or both of these two crack spreads. I certainly would like to see the crack spreads break out above the linear regression channels. Would just add another level of confidence to getting long these crack spreads. But directionally, that's where I'm heading. I think we're going to see the crack spread starting to widen. We may have seen the bottom for the short term. So let's move over to the externals. This slide has got a lot of things on it. It's not as complicated as it might look at first glance. What we have here is on the left, I'm showing the relationship between the spot continuation chart of WTI versus the spot US dollar index. Again, the US dollar index is against 7 different currencies. And then on the right, I'm showing the spot WTI versus the spot S&P futures contract. And you can see the dollar and oil are inversely correlated, where the dollar and equities are directionally positively correlated. Down at the bottom of the charts, I show the 10-day moving average of the correlation between each instrument. We've seen directionally the correlation, the inverse correlation, widening, becoming more and more correlated, except for the last couple of weeks as the market kind of got into this inflation fear and interest rates rose. When interest rates rise, interest rates are one of the main fundamental drivers of currencies. Rising interest rates tended to prop up the dollar a little bit. So the correlation relationship came down to about a negative 22.8 or 23%. Kind of not real correlated in the short term, but we've spent a lot of time over the last 6 months or so where we were highly negatively correlated between these two. And I believe we're going to see the dollar gain starting to ease here in the short term. So pay attention to that, and the market could grip on that. On the other hand, on a positive correlation, this spread is just, this relationship has just been rising. We closed the week out, the 10-day moving average correlation at 0.868, which is very highly correlated. And we saw over the last week or two that as the equity market is ticking up, so is oil. And then you can actually do this against any variety of equities. You could do it against a global basket. You could do it against Brent. And the market has put, over the last week in particular, a lot of emphasis on this relationship and has helped to push prices up here a bit. So the externals are there. They're not both in sync, but the market has been focusing much more so on the uptick in futures, equity futures, and I would expect that to continue going forward here, at least in the short to medium term. I think the worst is over for equities. I think there's going to be a lot of volatility. We're certainly not moving straight up. We're not at the highs that we hit before the correction, but we're moving back towards that direction, and it's probably going to be a choppy path as we get there. And as such, it'll be a choppy path on the oil side because it will influence oil. So we need to pay attention to this as we move forward. Let's look at what's happening with the dollar again and the implications on the OPEC strategy. What we have here is, again, this is against the US dollar index, and what I wanted to show you here is you can kind of see the makeup of that dollar index. It's against 7 different, it's the US dollar against 7 different currencies. It's a weighted average index with the vast majority of it against the euro. So big influences from the euro. The second largest impact is against the yen, and then lessers as we move there. So what we have here on the chart going back to the beginning of 2016, the red line is the OPEC basket of crudes. It's the OPEC basket of crudes. It's the OPEC basket of crudes published every day. It's an arithmetic average of a crude from each one of the main OPEC producing nations. And then the blue line is that OPEC basket of crudes adjusted for the US dollar index. So what we saw here going all the way on back to 2016, the dollar relationship, it was pretty much stable, and the OPEC basket price. And why is this important? This OPEC basket price, when we adjust it for the dollar, it's kind of a purchasing parity. It's kind of the purchasing power of OPEC in this basket of crudes. Oil is transacted in dollars. OPEC is getting dollars for their crude oil. And the market, OPEC adjusted basket versus OPEC, when they informally came to the agreement in September of 2016, still pretty good. Also pretty good when they actually declared it officially in 2016, and it kind of stayed that way um, for several more months until we got to the middle of last year. When we got to the middle of last year, we started seeing a separation where the OPEC basket, adjusted for the US dollar, started moving away from the OPEC basket in US dollars, primarily because the dollar started getting weaker. And now we have a relatively large gap. You can see here in the table when OPEC informally agreed here in September of 2016, there was only about $1.97 a barrel difference between the adjusted price being below, or OPEC's purchasing power being slightly below the dollar value. And then we got to when OPEC made their agreement formally, about 69 cents a barrel. The OPEC basket in dollars was a gainer over the adjusted basket, meaning OPEC had a little bit more purchasing parity associated. But now, as of Friday, it's basically the OPEC basket, or the purchasing power, has depreciated by 10.2%, or about $6.43 a barrel, meaning that for that basket of crudes in dollars, OPEC's purchasing parity, when converted to dollars using the ratio of the dollar index, is $6.43 a barrel lower. So they're not quite there yet. They're not quite gaining what they're doing. So I kind of look at this as being a motivator for OPEC to continue with their high level of compliance, because they're not really truly realizing that dollar value. They need more, and so they're going to continue to try to push this value higher, especially if the dollar continues to depreciate in value. So right now, OPEC is behind as far as purchasing power is concerned. As again I said, I think this is a motivating factor to keep OPEC in a high level of compliance, because they want to get this basket and this OPEC thing much more in sync with each other. So what's the fundamental? We got a few short charts this week from what's been going on. I think the two most interesting areas is U.S. crude oil production. It's going. It's continuing to grow. I mean, first of all, these are the 5-year averages, the average, the maximum, the minimum. We're well above all of that so far in 2018. This gold line in here is the highest annual average that was recorded in 1970 at 9.637 million barrels a day. And this green line is the highest monthly average recorded in October of 1970 at 10,013,000 barrels a day. And lo and behold, here's where we are. We're at 10.270 as of the latest EIA report that was issued on Thursday. We are at historical high levels. We've never been this high before. So production is growing. Certainly that's a thorn in the side of OPEC. But interestingly, look at where we are when we look at total combined inventories of crude and products. I like to look at this chart. I think this chart is very telling from the perspective of whether it's crude or whether it's products. Oil is oil. And lo and behold, look where we are. We're within 24.8 million barrels of the 5-year average. And we're 161 million barrels away from the highest level hit sometime in February of last year. So remember, OPEC's objective is to get inventories down to the 5-year level. The U.S. represents a major percentage of global inventories, and we're going to get there. I project that we're going to be at that 5-year average towards the end of the first quarter or sometime early in the second quarter. I mean, it's earmarked to get down into that level. What's happening? A little bit of volatility is going to be coming into the market. Refinery runs are going down. Remember what I said, we're below the 90% level. We're into the refinery maintenance season. We'll be there for another month or so before we can expect to see refinery runs starting to go up. In the meantime, we'll probably see crude oil inventories maybe starting to go up here as refinery demand goes down. But on the other hand, as refinery runs stay at lower levels, refined products will production will go down, and it goes back to that previous chart. We should expect to see total inventory starting to decline. I like the idea of looking for an opportunity to buy the crack spreads. Refinery runs are going down. Crude should be a little bit less bullish, but refined products should be a little bit more bullish. So I would expect to see those crack spreads widening out here in the not too distant future. I like this chart. This chart says a whole lot, and it certainly contributes to why, with U.S. crude oil production at a record high, why total inventories of crude and products are starting to go down. This chart is the total net of imports of crude oil and refined products together. That's imports versus exports. And look at where we are, down to 2 million, a little over 2 million barrels a day as of last week. This is tremendously low, especially when we look at things like the 5-year average and the 5-year max. The U.S. is slowly becoming and getting near being a net exporter of oil. We're net exporting refined products, not quite there yet on crude oil, but we may very well get there at some point in time. So with several million barrels a day, averaging kind of between 1.5 million and 2 million barrels a day of crude oil being exported, certainly it's keeping inventories down. And as I said before, we're a net exporter of refined products, and it's contributing significantly towards keeping those inventories down. This week, inventories, as I mentioned, are going to be on the regular schedule. I'm expecting crude oil to build about 2.2 million barrels. I'm expecting both gasoline and distillate fuel to decline. Refinery runs are probably going to come down again. We should be down to the mid 80s. Total crude and refined products are probably going to decrease a little bit along the way. So it'll continue to start pushing that total number closer and closer to the 5-year average. So this is where I'm projecting inventories as of the recording here of this. So is the OPEC Accord working? This is something we have to ask every week, actually every day, really, because it's such a significant and historic accord, because OPEC has tried these things many times in past years and has never been as successful as they've been with this particular arrangement. So yes, is it working? I believe it's working. Crude oil prices increased again last week, actually for the second week in a row. The short-term fundamentals, we saw an improvement with a pretty strong decline in total combined inventories in the United States. And basically, we may very well remain in a destocking pattern. And to answer that question, it's going to come out to how much is crude oil inventory is going to increase as refiner demand goes down during the maintenance season, as compared to how much is a refined product production going to go down, and how will demand, both internally and export demand for refined products, evolve, and if it goes the way it's been going, we certainly could expect to see those total inventories continuing to go down. Right now, these total inventories are down by 161 million barrels compared to hitting a peak in February of 2017. They're 24.8 million barrels above the 5-year average. I truly believe we're going to get to that 5-year average by the end of Q1 or early Q2. And I think as that happens, OPEC is going to be elated, because that's what they're trying to accomplish. Not just the United States. Certainly the United States is a major portion of global inventories, but global inventories are going down in many sectors of the world, and this is what OPEC wants, and this is where OPEC wants to get things done. And so far, it's going in their direction. Everything is moving properly. So compliance remains very high for not just OPEC, but the non-OPEC producers like Russia. Uh, and OPEC, not only are they excited as the way things are going, they've seen a significant increase in prices. They've seen a significant reduction in global oil inventories. But last week, there was talk coming from a couple of the ministers about initiating talks for a long-term agreement beyond 2018 to start talking about that when they get into their June OPEC meeting. I think OPEC is now kind of looking at the point to saying, we probably have a pretty good probability of getting global inventories down to the 5-year average. But now, how do we keep them there? We certainly don't want to see inventories surge like they did in 2014 and 2015. And on the other hand, we don't want to see inventories decrease to historically low levels because that'll send prices surging and that'll start having implications on global demand. There is elasticity of demand. So a very, very interesting conversation is going to start taking place as to OPEC moving from a very, very strong offensive position to a maintenance position. So that's what we need to pay attention to as we're going down the road here. Also, OPEC is looking at what's been happening in the U.S. on the production side. So far, as I said, production's been hitting historical levels, but inventories are still going down. We'll have to see how long that evolves. I mean, we're already now 633,000 barrels above the average annual record high in 1970, as I showed you on that graph a few slides ago, and 257,000 barrels above the monthly record high hit in October of 1970. All signs suggest that we're going to be over 11 million barrels a day of crude oil production by the end of this year. Depending on how global demand grows, will have a lot to do with how this whole global supply and demand balances evolve and ultimately net result on inventory. Total U.S. crude production now is 14.5% above where it was a year ago. That's a pretty good growth factor, and how that continues to go will certainly impact prices and what OPEC chooses to do going forward. So let's take a look at a quick peek at the temperature forecast. We're at the tail end of winter. We're right around the corner from March. It's the last month of the so-called official heating season. The official heating season is October through March, although we will know sometimes we get colder temperatures in certain heating regions of the U.S. in April. What we're seeing right now is the warm weather that we've experienced through half of February is starting to ease out. We're starting to see some normal temperatures come in, and by the time we get to the middle of the first week of March, we only see a small area of above normal temperatures and more normal to below normal temperatures, which would be a little bit more supportive for the heating fuels market, for heating oil, for natural gas, for propane, certainly for electricity demand. But let's always keep in mind that cold temperatures this time of the year are nothing like cold temperatures in the middle of the January. So yes, we're going to see a little bit of an improvement in heating fuel demand, but certainly it's not going to be any surge along the way. So it'll help a little bit. It'll be supportive of the ultra low sulfur diesel prices. It should be supportive of the ultra low sulfur diesel crack spreads going forward. So in conclusion, clearly OPEC remains committed. I mean, there's no reason to believe that OPEC or their non-OPEC partners are going to change their strategy anytime soon. It's working, period. There's no reason to do anything about it other than to commend themselves and continue to go forward with it. The short-term fundamentals improved last week. It's still a question mark. Will it continue? Again, I come back to the relationship between crude oil, decrease in crude oil demand because of the spring season, refining maintenance season, versus a reduction in refined product inventories. The externals are going to continue to play a major role. I expect the equity market to be more prevalent than the dollar. But I also believe over the next couple of weeks, the dollar will probably get weaker again, and we'll have both of these in sync. The market sentiment is improving. We've gone pretty much from being cautiously bearish to kind of neutral with a little bit of an upside bias. We're watching that dollar though. If it does surge higher, that could change things around a little bit. And we're watching these total combined inventories. If they remain in a destocking pattern, very supportive and certainly would push prices higher. On the technical side, on the like I like to call it the herd side, the market herd side, it's not a crowded trade anymore, and the market is no longer overbought. The complex is still below the highs hit, but we seem to be heading in that direction. I think that the medium term, I still expect prices to go higher, and I do continue to fly the caution flag because we can't definitively say the correction in equities, the correction in the dollar is over. That could continue to have a negative impact on the oil complex going forward. So we remain of the view that I'm still kind of a little bit neutral, but with an eye towards getting long. I rather get long. I'm done with short positions. I think it's a time to look at small, long positions. I think it's a time to add more hedges if you're a buy-side hedger, whether you're on the refined product side, whether it be on the gasoline or the diesel side. I think the Brent WTI spread has stabilized. We gained ground again last week. U.S. exports of crude oil are certainly helping and impacting the spread. And basically, we're certainly not anywhere near the highs of the spread hit back in December of 2017. When the economics for exporting crude were probably twice as much as they are right now, but they're still profitable. I strongly suggest that for those that are going long oil, equities, or short the dollar, continue to use trailing stops. These markets are going to be volatile, at least in the short term, at least for the next 2 to 3 weeks. I don't mean just volatile, I mean above normal levels of volatility. As we just talked, we're keeping an eye on the short-term forecast that could give a little contribution to the low sulfur diesel versus RBOB. Kind of neutral for that spread, but looking for a window to maybe get long the diesel, short the gasoline here. And the crack spreads, I am definitely looking for a window to get long those crack spreads. And if the short-term weather forecast stays, I think I would probably lean towards going long the diesel spread first before I do the gasoline spread. Well, that concludes my comments for this week. First of all, I want to thank you for taking time from your busy schedule to join me in this presentation. I hope it helps. I hope you have an extremely successful week of trading and an extremely successful week of hedging for those hedgers out there. And I certainly would recommend you keeping your seatbelts fastened. It is going to be another volatile week. The financials are far from stable, and any major significant move in the financials could certainly have a corresponding impact in the equity, in the commodities market, in particular in the oil market. There's a lot of economic data going to be hitting the media airwaves, and the market's jumpy, so we could see some very, very short-term action. Volatility is going to remain above normal at least through this week and probably for the next several weeks. So pay attention to a lot of things that you don't normally pay attention to, because everything is in play right now. It's not simply about the fundamentals of oil. It's not simply about the technicals of oil. It's about the whole global economic structure that's evolving, in addition to the fundamentals and technicals of the oil complex. So again, good luck with your activity. You can participate by taking a trial subscription. You can subscribe to our publication by going to these websites. You can subscribe to What's Up Monday. You can certainly look at our other publications that might be of interest to you, as well as all of our courses. We now have a large number of our full length live courses that are available now online for those that prefer that method of delivery. So hopefully we'll see you in other areas of our business. Again, if you have any questions, please feel free to email me at dchurichello@emi.org. I generally answer all my emails and would love to hear from you. So again, thank you for listening, and good luck in your endeavors this week.